All right, let's just jump right in. For decades, we've had this pretty set idea of how global investment works. But right now, that whole map of where money is flowing is being completely redrawn. I mean, we are living through a massive structural transformation, probably the biggest shift we've seen since the end of World War II.
So let me just ask you this, just to frame the whole conversation. If I handed you $1 trillion right now, and I mean your job is to make it grow, but also keep it safe for the long haul, where would you put it? It sounds like a simple question, right? But the answer has gotten incredibly complicated.
For the last 30, maybe 40 years, that answer was a no-brainer. You'd just find the country with the cheapest labor, the most efficient ports and roads, and boom, that's where you'd build your factory. The entire world was basically running on one simple rule: efficiency.
Well, that world is gone. Seriously. The old rulebook for globalization, the one that was all about efficiency, it just doesn't apply anymore. We've entered what some leaders are calling the age of inflection.
This quote right here, it really gets to the absolute heart of the new reality. Capital is more sensitive to political risk than goods are. So what does that actually mean? It means that today, investors care more about whether their partners are politically aligned and their supply chains are secure than they do about just finding the cheapest labor. Safety now trumps cost.
So, what does this look like on this new map we're talking about? Well, we're seeing the rise of what you could call new economic fortresses. The big established powers are pulling their most critical industries back home. You've probably heard the term reshoring, and they're tightening up supply chains with countries they consider politically friendly or friendshoring. And the logic behind all this has a name: geopolitical distance. It's a really simple idea, but it has these massive, world-changing consequences. See, investors aren't just looking at how many miles away a country is anymore. They're looking at its political distance. They're trying to shrink that gap, keeping their money in countries they trust, even if it costs a bit more.
And this chart right here shows you exactly where the money's going. Just look at the flow of investment from advanced economies. Go back to 2010, and about 10% of it was heading to China. Now, that number has absolutely plummeted to just 2%. So where did all that capital go? It's consolidating. Investment between these politically aligned advanced economies has just soared to 45%. It's a huge retreat into these new economic fortresses.
And the main anchor for this new fortress? It's North America. The value of brand new projects in the U.S., we're talking building factories and facilities from scratch, it surged an incredible 93% in 2024. And this isn't just random spending, it's laser-focused on the industries that are going to shape our future: AI and advanced semiconductors. But this whole rewiring of the global economy isn't just about the old powers building walls. As money pulls out of some places, it creates this massive vacuum, and that's giving rise to a whole new set of challenger hubs all over the world. I mean, this slide tells a huge part of that story. While investment flowing into China dropped by 29%, the ASEAN bloc, that's the Southeast Asian nations, saw their inflows jump by 8.5%. That's a regional record. You can literally see the pivot away from the world's factory happening in these numbers.
And it's not just one country picking up the slack. It's a whole ecosystem. You've got Vietnam, which is becoming a magnet for electronics manufacturing because its costs are about 50% lower than China's. Then you have Indonesia, which is using its huge nickel reserves to become a global player in EV batteries. And don't forget Malaysia, which is climbing up the value chain, getting into high-end semiconductor design and packaging. See, they're not just cheaper options, they're becoming sophisticated industrial hubs in their own right.
But maybe the most surprising story of all is what's happening in Africa. In a year where global investment actually went down, the money flowing into the continent shot up by a staggering 75% to a record high. We're not talking about small projects here. This is being driven by massive mega projects. It really signals a new era for finance in regions that were often overlooked.
Okay, so the map is clearly changing. Money is flowing to these new, exciting hubs. But this brings us to a really tricky paradox for any investor. Is the fastest-growing economy always the best place to put your money? Well, the answer is way more complicated than you might think.
Just take a look at the world's fastest-growing economies right now. You've got places like Macau, South Sudan, and Guyana posting these absolutely explosive GDP numbers, often because of a tourism rebound or a massive oil discovery.
So, this is it, right? This is where you should be pouring your money. The growth is just undeniable. But just hold that thought for 1 second.
Now look at this slide. These are the top-performing stock markets. Do you notice anything? There is almost zero overlap with that last list. The places that are actually delivering the highest returns to investors are markets like Colombia, Ghana, and Chile.
And that right there is the paradox in a nutshell. Just because an economy is growing like crazy, that doesn't automatically make it a great place to invest. You need more than just raw growth. You need a stable, mature market where investors can actually get their money in and out. It's about finding that sweet spot between growth potential and real-world stability.
So what does all this mean for the people who are actually running the world's biggest companies? Well, it means the old corporate playbook is totally obsolete. They need a brand new one that's designed for this new world of geopolitical risk and crazy fast technological change.
I mean, the entire role of the corporate boardroom is changing. The old boardroom was, let's be honest, kind of a passive place. It was mostly focused on checking the boxes for financial compliance. The new boardroom has to be a strategic command center, actively wrestling with these huge, thorny issues like the risks of AI and the resilience of their supply chains.
And this new playbook, it's really built on 3 core pillars. First, AI accountability. Boards now have to actively manage the massive legal and reputational risks that come with AI. Second, geopolitical resilience. This means they need to see what's happening not just with their direct suppliers, but deep down, tiers 2, 3, and 4 of their entire supply network. And third, specialized composition. You simply can't govern what you don't understand. So boards are now hunting for directors with very specific expertise in things like cybersecurity and the digital economy.
And the stakes for getting this right are just enormous, because as this timeline shows, the world's economic center of gravity is making a decisive shift to the east. What we're seeing right now in 2025 is just the start of the rewiring. By 2030, India is on track to become the world's second largest economy. And by 2040, Asia as a whole is expected to generate over 40% of global GDP and be home to a majority of the world's biggest companies. This isn't some far-off future. It's the world being built by the investment choices we're making today.
Which really leaves us with one final, critical question. The old model pretty much assumed that capital was borderless, that it would just flow to the best idea no matter where in the world it was. But if we're now living in a world where capital has a nationality, where it's guided by political alliances, where will the next great innovation be built? And maybe more importantly, who will get to build it?